Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have a busy show with the EIA data. We're going to try to rope in some OPEC information that's come out. You know, there wasn't too much to discuss given what happened last month. So it'll just be a quick primer as to what were some of the new indications and then what does that mean for some of the export market. We're going to have our normal backdrop of part one is going to look at the overview. What did we see? What are we expecting? Part two is going to be a deeper dive on refined product demand. And then part three is going to, again, look at the export market, OPEC, and what is happening in the physical market versus the futures market. Because right now there's some interesting data points that are, essentially opposite each other. So we want to look at which one do we think is going to win out over time. So before we jump right in, please like, share, subscribe. You know, you sharing this helps us an incredible amount. So we appreciate you for your support. Before we get into some of the data, we just want to look at what's happening in crude futures and looking at the curve. So we can just see, you know, the orange line is the one that I snapped about an hour and a half ago, essentially right after the number, just to look at, you know, how far out are we above 50 in terms of backwardation in general. You know, you can see that we're pretty much in steep backwardation, but you can, you know, we're above 50 until July of 2022. So again, you're starting to see this capacity to hedge, to get some protection to the downside. You know, how many companies will do it? How many of them will look to do not just 2021, but start to nibble at 2022? That's going to be interesting. It's always going to come down to pricing. You know, what are some of the availabilities? But again, we're looking at the ability to lock in cash flow. We have discussed ad nauseum what was Saudi Arabia thinking, you know, what is their end goal in general, just because this is a huge lifeline that has been thrown to the U.S. markets. And we've seen that in terms of U.S. Oil exports. We've seen that in terms of pricing, which is going to keep and accelerate activity within the U.S. And these are things that we're looking at to really appreciate, you know, where are frac spreads going? Where is U.S. production? What are these data points really going to look like? And how is this going to impact refiners in general? So then when we look at, Persian Gulf exports to the U.S., this is something that it's starting to move higher. And when we think about what is going to happen over the next few months, really, we think that this number is going to continue to drift back to, you know, let's just say where it was in 2019 in terms of just opportunities and the need to bring in some of this heavy crude, especially as we have refinery throughput sitting at that, you know, let's call it 82.5 to 83% margin. We're going to need these barrels to come into our market. Again, we're not going to get back to where we were in 17, 18 because we are still operating at a much lower rate, but we're still going to see some of this crude start to bleed back into the U.S. market. We can see Saudi Arabia, Iraq were big components. You know, the one that we think is going to see the most increase will be Iraq, especially with Saudi Arabia cutting, their cuts start as of Feb 1, that voluntary 1 million. So again, there's going to be a certain amount of tightness in the market, but yet it's not across all grades, and that's something that we're going to talk about a bit more in segment 3. So getting to the crude draw, you know, we had a crude draw of 990,000, which again is a nice continuation of where we saw last week. You know, we thought there was going to be a little bit of an increase this week, but again, the exports remained very strong going into the market, which helped offset that big increase in imports that we were expecting and that we did see come across in the data. So just looking at it, you know, again, we stopped showing the aggregate with SPR just because they're pretty much the same. You know, when we look at some of the data points as we were expecting, PAD 5 saw a build as we're starting to see a little bit of loosening on lockdowns. You know, you're going to have a bit more demand in PAD 5. So they're starting to get some crude in there in order to prime the system before they start to increase some activity. So that's one that isn't surprising. PAD 3 saw that draw of 1 million. Again, that's going into the export market, even though we had imports. That is also pulling down from Cushing. So Cushing had a continuation and a very strong continuation, which is going to be supportive of WTI pricing just in the near term. And then PAD 2, even though we had a big increase of imports from Canada, we're still seeing a lot of activity in PAD 2, which is keeping those draws fairly strong. So when we look at crude oil in general, you know, again, they're showing 10.9. That's where we thought we ended last year. And when we look at what is going to be the production over the next 30, 60, 90 days, you know, we think that we're going to be able to hold the line here, just given the activity that we saw coming into December. Then we had the slowdown just for holidays, and then we saw that come back very quickly. And just given where pricing is, what we were hearing on the ground, what we're seeing in our data that we collect, you know, to think that frac spread counts will exceed 185 by mid-February, I think is a foregone conclusion. And we'll start to see some of those essentially a little bit of a pickup in oil production as we get towards the end of March and as we head into April, just given the timing of when completions happen and when we actually see it in the data, as the frac spread count usually leads production numbers by 30, 60 days, depending on correlations and just, you know, the demand that we're seeing. And as you can see, we're starting to see that demand pick up. So then when we look at excluding SPR, you can see that we're essentially flatlining, but flatlining is a positive in regards to where we should be. So we typically see kind of a gradual, just looking at the average over the last 29 years, we normally see a gradual build in crude, and we're just not seeing that. Instead, we're seeing some drawdowns, we're seeing some pull through of product of oil, and we're creating product and a lot of it, which is again the other side of that dumbbell that we keep talking about. But again, these are things that we're starting to see that are positive in terms of pulling some of this crude out of the system. It's just, you know, really we can't see that this continuation unless we start to get that demand pickup on the other side, which, you know, there's points on both sides on why it will happen, why it won't happen. But again, these are things that we're going to look at in segment 2. Now, when we look at pad 3, we're finally back within that cloud. You know, we're back within the top, and you can see that we normally get these builds from January till about April. And instead, we're just, again, going flat, which is a positive to see. And it's really being driven more by exports. We've seen a little bit of a pickup in refinery throughput, but again, those export markets remain very robust for U.S. product, which again is the positive in terms of getting some of this normalcy on the Gulf Coast. Then when we look at Cushing, as we were saying, you know, this is the pace is great. Everything is moving quickly. The drawdown of exports and just activity in pad 3 on a refining side is going to continue to keep this coming through, which again is also going to bring support to why we can get some U.S. production going. You have places to put it, you can store it, you know, or just based on the fact that we're in backwardation, you can try to sell it as quickly as possible. So again, there are some things to look at, and the positives continue to point to a continuation of drawdowns within Cushing in general. And then when we look at imports, again, we saw that big spike of about 1.5 million barrels a day. Pad 1, again, seeing it, things on the coast. We had a little bit of a slowdown in pad 5, but again, we saw, as we were saying, we saw some of this continuation. We'll get another pickup in pad 5 imports. You know, the biggest two were obviously pad 3 and pad 2. We had that dip, and it was driven. There was a lot of weather issues. There were some problems in terms of getting flow through timing. That is now abated, and here you're seeing some of these big increases in terms of just data in general, specifically on pad 3. Pad 2 was, again, as we said, it's going to be lumpy, and clearly they made up for it not only on a year-over-year level, but on a 5-year average. Pad 2 continues to pull in a significant amount of specifically Canadian crude, where we just hit a new record on Canadian imports. So then when we look at the Gulf Coast, this is one that is going to continue to be lumpy. We closed the gap after this increase based on year-over-year, 5-year average. We're still down. But again, as we get a little bit more of a normalization in refinery throughput, which took a step back this week as we had some unplanned downtime, which we'll talk about and how that's going to impact gasoline in the next segment. But again, these are things that we'll continue to see some of this demand on imports coming into pad 3. Then when we look at utilization rates, you know, essentially closing out the month at 82.3%, you know, right near where we're thinking about that 83% throughput. That took a little bit of a ding as we had some unplanned downtime. So depending on when they come back on, we'll see this could dip. This could essentially take back that 60 basis points driven by pad 3, just in terms of some of the disruptions. PADD 5 had a little bit of an increase that should continue, especially as we see some loosening of restrictions in PADD 5. But the ones that we're watching is PADD 3, because that's really going to dictate where are those imports, how much floating storage is going to stay in the Gulf of Mexico, as PADD 2 continues to be fairly flat, and we don't see that changing too much. The delta in terms of where we think that increase going to 83.5% is really going to be in the Gulf of Mexico or PADD 3. So when we look at implied demand took a big step back, and it was driven based on what we were really highlighting, which was, again, jet fuel. Jet fuel was one that we saw that spike. Now we're going to see that fade, and that fade we think is now going to remain through not only just February, but well into March. Distillate is one that, it's still above the 5-year average, pulled back a little bit below the year over year. But again, distillate is kind of where we expect it to be, given the fact that there are some headwinds, but the tailwinds remain, which is going to keep it fairly stable in this level. Gasoline had a little bit of a walk back of 63,000 barrels a day. We think that this is going to start to reverse, and we're going to, again, move closer to over that 8 million barrel a day mark. But again, these are things that will take time, especially as we have a weather event for all those in the Northeast, or I should say the Mid-Atlantic at this point. And as it came across the U.S., I know we had 14 inches drop, and then we had snow drifts of up to 36 inches, where my middle daughter would literally sink into the snow. So that's going to impact some of this gasoline demand. So again, it's going to be a little lumpy. We should see this stay fairly flat into next week, and then we'll start to see that pick up as we kind of get into a bit more of a normal backdrop. As we said, crude oil floating storage, we thought it was going to fall back within the bottom of the cloud, and here we are. Again, that's going to pair with PADD 3. We see additional purchases and some additional VLCCs coming from the Middle East into the U.S. China and the U.S. have seen an increase in just capacity that's been flagged for coming into our region. Again, not getting to the 5-year average, but we will stay within this bottom of the cloud over the next few weeks, as we do have a bit more demand, and especially coming off of the floating market. And when we look at imports, as we were saying, we thought we were going to fall either just below or right within the bottom of the cloud. And again, here we are. It's something now at this level, it's not really going to go too much further up. It's just going to go a bit more sideways, which will be fairly bullish. I shouldn't say bullish, but fairly normal, just given, we're going to be back within that cloud in general. But again, just because we're still operating at such reduced rates, we're just not going to see the same type of import demand. Now, PADD 2, we were expecting it to have a strong bounce, come just above that 5-year average, but it clearly exploded to the highs. Took out the previous seasonally adjusted all-time high. Again, this is going to be lumpy. It'll fall back. We just think it'll fall back within that top of the cloud. But again, demand and imports into PADD 2 is going to remain robust, especially given pricing that we're seeing in the U.S., which will make some of the Canadian crude a bit more attractive. Again, pulling that back down, there's going to have that opportunity coming out of Canada. Then when we look at utilization rates, this goes back to 1992. There are only 2 years that are below where we currently are. It was 1992 and 2010. So again, we're still well below where we should be on a 5-year average, 10-year average. It's just at this level, we just think that we're going to be within this 83 to, let's call it 82.5 to 83.5 is going to be that comfortable move as we go through the remainder of February. And you can see that on that average level, on the average line, we normally have a kind of flat line. And then we start to see a little bit of an increase. We're expecting this to be fairly stable over the next few weeks, and really over the next 2 months, just given the push back and forth on export market versus demand internally. And this is going to keep imports depressed, but a little bit higher, just because, again, we're off that low of the high 70s. Coming into those low 80s, so we're going to have to pull some additional crude off the water. And then clearly the support within the U.S. is going to keep frac spread and just general production activity fairly strong. Now, the next question is, now that we covered kind of a bigger overview of not just the data, but oil, now let's dig into, well, where are we going to go in terms of refined product demand over the next few weeks, just given some of the data points that we discussed earlier.